The outlook for tighter monetary policy will hit the economy in time. The fixed income asset class, which has seen significant repricing over the last 2 years, but especially the last 1 year, is now again a more relevant asset class for portfolios. The 5 previous cases when stocks and bonds have fallen together, in all 5 6-month periods that have followed the decline, we've seen the bond market, the 10-year US Treasury, provide a positive return. 5 out of 5 cases.
The absolute yields we're seeing in the municipal bond space and investment grade space are yields that we haven't seen in many years, except for the COVID-related sell-off in March of 2020. So I think there's very good momentum in the muni bond space. We want to lock in decent yields right now that are very good versus comparable treasuries or comparable high quality corporates. But also from a momentum perspective, from a flow perspective, I think that there'll be a little bit of a tailwind in the municipal bond space. When we manage our portfolios, we're looking at munis as the high quality, tax-free diversifying asset class for our clients. And we do think that at current yield levels, we are providing that, or the municipal bond market is providing that for our clients and for investors.
I want to just describe again the real bogeyman here, the real fear, and that is inflation. We do want to emphasize that the outlook for tighter monetary policy will hit the economy in time. And this is the reason why we can imagine that the Federal Reserve will follow through on a number of large rate hikes this year. But it's extremely unlikely that the Fed would stay on that course in 2023.
A lot of the inflation that's priced into the market going forward, thinking like inflation break-evens, a lot of that is really very front-end loaded, right? A couple of reasons for that. Obviously, the big spike that we've seen in inflation, close to 8.5%, that is expected to go down, and that's borne by history as well, that typically when you see inflation spikes, they tend to be just that, spikes, they tend to come down. And second is that the Fed has certainly reacted to it. The one unknown, though, obviously, is where inflation really does land up. If it stands outside the Fed's comfort level, then there is a risk that the Fed might actually have to hike by more. And at that point, real yields can actually rise beyond what is neutral. I think that's one risk we have to consider.
We would prefer, for this period of higher economic risk, to invest in both higher quality stocks and bonds. The firms with the strongest history of raising their dividends consistently were not the best performers in 2020, but they have outperformed strongly in this environment.
Consumers' spending power is getting crimped here in the near term. So businesses that are benefiting from that, so to speak, you see like the value price retailers, you see suppliers, for example, that provide private label goods. Those would be things that are benefiting in this environment. One area that I think we think is pretty durable and we think will hold up pretty well and actually sees pretty good value is in the healthcare space. So healthcare, a lot of healthcare companies have widened in sympathy with the broader markets, but we think that they're relatively insulated here in the near and intermediate term from some of these cross currents. Another one that I think has widened a little bit, and I think this is kind of a gray zone, a yellow zone, would be in the technology space. So I'd say that that's one that we're a little bit more cautious on.
I hope we've at least made the case that we're in a very different place in fixed income markets than where we have been in the last couple of years, where we didn't even believe it added a lot of value to basic asset allocation. And we really think that getting yields now back up to very relevant levels, while we expect a slowing economy, that combination again is a really very good alternative to cash, as well as a good risk management tool.